Good morning, everyone, and welcome to our webinar on understanding financial statements made simple. This is designed for complete beginners as we advertised. So a quick note before we start, if you are already an accounting expert, like you've been in accounting for years, it might be very basic for you because the intended audience is someone with very little to no accounting basics. Okay, so over the course of the next hour and a half, hopefully less, we'll be going through the very basics of financial statements. So even without an accounting background, after today, you should be able to pick any set of financials and have an idea what the financials are talking about. This is not going to make you an expert in any way. I'll come to that. But the purpose is to make sure you acquire this very crucial skill of reading financial statements. It's very important that as part of the things you can do as an individual, you have the ability to read and understand numbers. Okay, so before we commence, we are social, so connect with us so you don't miss out on any future event. So if you're on LinkedIn, give us a follow on the MSL Business School page. If you're on Facebook, TikTok, X, formerly Twitter, Instagram, wherever you are, even YouTube, we have a YouTube channel, right? I think I'll mention that please don't unmute if you've not been given the chance to, right? Okay, so like I was saying, we are social. So wherever you are on social media, whether TikTok, Instagram, LinkedIn, wherever, give us a follow. So future events like this, you'll be the first to find out. Okay, so like we said, we are going to talk about financial statements for the beginner. So what is our agenda for today? What are we discussing today? We have a very basic plan for this morning. We'll start with an introduction. We'll look at what we call the language of accounting. We would speak about business models. We'll look at the content of a typical set of financial statements. We'll touch on the primary financial statements in some detail, and then I'll take any questions you may have. Sounds like a good plan, I believe, right? So let's go straight into the business for this morning. First and foremost, probably this is the first time you're hearing of the MSL Business School. Who are we? We are basically the leading provider of business education for professionals in Ghana. We are utilizing the power of technology to train the next generation of business leaders. So as you can see, screenshots on the screen, that's the MSL Business School app, the ecosystem powering the business education we're providing to the next gen business leaders. In terms of what we offer, at the moment, the ICAG program, that is for chartered accountants in Ghana, the CIT program for those who want to become chartered tax practitioners. We run masterclass programs on specific topics. And then we have corporate training or on-demand training programs. So if you have any training need, feel free to reach out to us. Your organization needs someone to train them on anything, right? Or you want this same session at a more detailed level for your finance team or whoever is in your company, the sales team, marketing team, reach out to us and we're happy to run a very detailed one for your organization. How do you reach us? If you need world-class tailor-made training, you can just scan the QR code on the screen. It will take you straight to our WhatsApp business number, and then you can chat with the team. Or you can just drop an email at mslbusinessschool@gmail.com, right? So if you want any tailor-made training for your organization, feel free to reach out to us, and then we can discuss how we can give you the best possible training at a level anyone will understand. So back to the business for today. Before I start, I love disclaimers. So to set the ball rolling, to make sure everybody's on the same page, this will be an introductory session, okay? Introductory session. It is not designed to make you an accounting expert in under 2 hours. I've been studying accounting for more than 10 years, close to 15 actually, if I add pre-qualification, right? You can't learn in 2 hours what I learned in 15 years. It won't happen. But what I can guarantee is you'll gain a solid understanding of the essentials of reading financial statements. You will pick a set of financials and you will not be lost. Like you would know at least what are the numbers trying to communicate. So that's a clear disclaimer. You will not become an accounting guru in less than 2 hours. It's not going to happen, right? Okay, so let's start with the most important thing for today, which is that accounting is a language, perhaps just like any other language you might have heard of, right? I'm speaking in English today, and you are listening and hearing me in English. So English is the medium or language of communication this morning. Someone who speaks French. What is a language supposed to do? A language is supposed to convey a message. So whatever I'm saying is a set of letters put together to become words. And when I say them, you understand because you understand English. So everything I've said so far makes sense to you. It's not gibberish because you speak English, right? But let me say these same set of words to someone who never has contact with English. Let's say someone in China, born and bred in China, never speaks English. Everything I'm saying is going to sound rubbish to them. It will make no sense, no meaning to them. Why? It's the same set of words I'm using, but he doesn't speak English. So accounting is a language. And if you don't speak accounting, you will not understand financial statements. So one of the big goals for today is to make sure you understand the basics of the language. So when you see anything accounting or financial statements, you'd understand and you won't be like the Chinese person saying English for the first time. Are we good? So accounting is a language. Financial statements are prepared in this language. I've been speaking this language for over a decade, and today I'll attempt to teach you the very basics of this language of accounting. So every language has basic words every beginner learns. Let's take French, for example. When I did French in junior high, senior high, and even uni first year business school, we were taught the basics. So I'm sure many of you here know manger is to eat, boire is to drink, dormir is to sleep, right? Comprendre is to understand, right? Partir is to leave. You learn these basics because you try and construct certain sentences. So for example, if I'm to zoom in, someone will say, for example, je vais à la boulangerie, I'm going to the bakery. You need to know that there's something called aller, which is to go. And I'm sure we're taught the conjugation of aller for those who did French in school, right? Why? So that when you see je vais à la boulangerie, you know I'm going to the bakery. Accounting is a language just like this. But the same way no French course can teach you the basic language for you to speak fluent French in just a few minutes. It's the same way today I'm going to teach you some basic words. So the way I to teach you, okay, aller means to go, marcher means to walk, finir means to finish. Today I'll teach you the very basic words, concepts that if you understand, you can at least have a conversation accounting. You might not be fluent, but accounting will now make some sense to you. What would these words be? Assets, liabilities, equity, income, expenses. So take notes of this. I'll take each one and then we'll explain. So assets, liabilities, equity, income, expenses. Assets, liabilities, equity, income, expenses. Accountants have a name for this. They call them the elements of financial statements. But forget about all the accounting jargon, right? So these are the basic words as beginners we need to understand. So on the screen, I have the expert's definition and the beginner's definition. We are beginners, so I've deliberately canceled the expert's definition. And I am an accountant, so when I'm speaking to a fellow accountant, I'll use the definition that has been canceled here, this one. But for our sake, at least I'm sure you can still see that definition if you want to see it. We are going to use a very basic part of everything. So what is an asset? I'm sure everybody here has heard the word asset before, but today we'll put the word asset in the right context. Assets are basically things that belong to the business or that a business controls. Because as you may find out as you progress in accounting, you may not own something legally, but you may have control over that thing, right? So there's something called a lease. I will not bore you with the details. You don't have legal ownership of the asset, but you have the right to use that asset. So that asset is on your balance sheet, which I'll come to shortly. Okay, so anything that belongs to the business or that a business controls, which brings it some form of value. So for example, if you're a business, the cash in your bank today is yours. The building the company owns is yours. The computers, the inventory that you sell, your stock of goods, they are all assets. So we need to first understand that, okay, first term I'm learning in this new language called accounting is assets. anything that belongs to the business or that the business controls, which is expected to bring the business some value at some point in the future. We'll come to the types of assets shortly. Are we good with assets? The next will be liabilities. I'm sure this is also not a new word to anybody here. It's an English word, right? Once again, the expert's definition is up, strike through done. The beginner's definition. Liabilities are debts or amounts the business must pay to other people. See it from that angle. Any amount you are supposed to pay somebody else. It's an obligation you have today because of something that happened in the past, which will lead to you having to pay somebody something, right? Examples are loans from the bank. If you go to the bank for a loan, you have a liability. The bank will expect you to pay back that loan at a certain time in future. If you have unpaid supplier bills, you sell, let's say, food items. You go to buy food items from your supplier. You didn't pay them in cash. You promised to pay in 60 days. That period between when you bought and the 60-day payment period, you have a payable to them. You're supposed to pay them some amount of money. It's a liability you have. Or rent due. Maybe your landlord, for where you do your business, has said it's time to pay your rent or renew your rent. You haven't yet paid. At the time it's yet to be paid, it's a liability. So basically, any debt or any amount you must pay to somebody else outside the business is a liability at the beginner's level. So you've understood assets, you've understood liabilities. Let's now come to equity. What is equity? Basically, after you pay off all your debts or your liabilities, whatever is left will belong to the owners. So we have something called the accounting equation. When you take your assets and you subtract your liabilities, whatever is left is equity. So like I said here, if a business owns $100,000 in assets, but it owes $40,000 in loans, and that is the only liability they have, then their equity is $60,000. So we would say it's the residual interest in your assets after taking out liabilities. Let's go over. Assets are the things that belong to the business or that the business controls, which we expect to bring some value in future. Liabilities, debts, or amounts the business must pay to somebody else. When you subtract your liabilities from your assets, you get equity. In some cases, you might even see equity being called capital for a sole trader, for example, because they might call it capital. Okay, so assets, take out your liabilities, whatever is left is your equity. And we'll find out when we get to the balance sheet that the balance sheet, if you haven't heard it before, don't worry, I'll talk about it shortly, actually depicts the accounting equation. What is income? For income, the expert's definition is very complex. You can see it's very long. Once again, I've canceled it. At our level, as a beginner, this is how the business earns their money from selling products or services. So I'll discuss business models with you shortly, right? Whatever you do to make money is your income. If you're into the sale of food at a restaurant, that is your income. If you're a service provider, you take photos of people at their events, a photographer, whatever they pay you is your income. So whatever you do as a business, whatever money comes from that is your income. And I'm sure income is not a new word to anybody here. So income. Then final thing we'll have to look at is expenses. Once again, the beginner's definition is these are the cost of running the business. So as a business, you probably have to pay rent to your landlord. That is a rent expense. If you have employees who are working for you and you're not a sole proprietor, you need to pay salaries. It's an expense. You need to pay electricity. You need to pay for supplies. Anything. Any cost of doing business is going to be called an expense. Quick recap. There are 5 super important terms that every beginner who is now learning accounting should know. Who wants to read financial statements? You should be able to know what assets are, what liabilities are, what equity is, what income is, and what expenses are. On top of this foundation we are building, trying to build a superstructure, let's look at a few extra terms we need to understand. 2 keywords, current and non-current, right? Now, when we say current, don't see it like electricity current. Put that one aside. In accounting, when you hear the word current, it means it's going to last for less than 12 months. Are we good? Current. So when we get to the balance sheet, which I'm building up to gradually, anything current is expected to last for less than a year. So we'll find out we have current assets, current liabilities. And I've just mentioned what assets and liabilities are, right? So we'll find out that, okay, a current asset is anything I own that brings me value that will last for less than 1 year. Are we good? And non-current assets, let's come back here, will be anything that will last for more than 12 months. Are we good? So what makes something current or non-current is just the threshold of 1 year. If it's less than 1 year, it's current. If it's more than 1 year, it's non-current. Less than 1 year current, more than 1 year non-current. Then we have cash flow. Why am I mentioning cash flow? It's important because cash and profit are not the same. Cash and profit are not the same. So somebody might be making or running a business. They have sales of, let's say, 1,000,000 cedis. Then their total costs will be 800,000. Their profit will be 200,000. But guess what? If this 1,000,000 cedis was not collected in cash, as in he sold the goods on credit, this 200,000 is not the same as cash flow. It's not cash. It is a profit. The only time the profit of 200,000 will equal cash is if all the sales of 1,000,000, we collected it in cash and we paid all our costs in cash. And not all costs to be cash. There's something called depreciation. It's a non-cash item, right? But you put that aside for now. At least we know current versus non-current. We know cash flow. What is profit or loss? Generally, we explained income and we explained expenses. If your income is bigger than your expenses, in total, you have made a profit. And it's simple, right? So this example here, you sold goods worth 1,000,000. Your total cost was 800,000. What you had left over was 200,000. It's a profit. So profit is basically the excess of your income over expenses. If all the money you made in your business is bigger than all you had to spend to make that money, then you've made a profit. On the other hand, if your expenses is just the opposite, right? If your expenses exceed your income, then you have made a loss. So this same example here, let's turn the numbers around. Let's assume sales were rather 800,000 and it cost the person total cost of 1,000,000. Then they have made a loss of 200,000 in bracket negative. So that's all. Profit or loss. It's just the relationship between your income and your expenses. Then one final word you might hear or see around if you are really going to analyze financial statements is this word audited. What does the word audited mean? Audited at a beginner's level basically means an expert, an independent third party who has no relationship with the company and can be very objective, has been consulted. That person is called an auditor. And they've been called upon to come and apply their expertise, to go through the books, go through the numbers, and issue something called an opinion. It is basically their viewpoint, okay? So what the auditor is going to do is that after doing all their work, they issue a document called the auditor's report. And all that document says that I, as an auditor, I have reviewed the financial statement. In my view, the financial statements show a true and fair view of the financial performance, position, and cash flows of the entity. This is accounting jargon, but I'm saying this because when you pick an annual report, you come across the audited or the audit opinion before you see the financial statement. So whenever you see financials, ask yourself, are these audited financials or they are unaudited financials? Right? If you are in Ghana, currently, I'm sure if you walk into the branch of any bank, go to EcoBank or any of the branches, you see in their branch, they have pasted their unaudited 2024 numbers in branch. Who has taken notes? Anyone, if you have, you'd notice that when you go, because most likely around this time, audits are ongoing, right? So if you went in January for sure, maybe late or mid-January, you'd see in the banking hall unaudited financial statement. They are telling you that these are our numbers, but the auditor has not yet double checked to give his opinion, right? So for audits, I'm sure you've heard of the big four, so PwC, KPMG, EY, Deloitte, and any other audit firm. These are professionals who have gone through the training, who speak the language I'm trying to speak or teach you to speak. And because of their expertise, they're able to put through some audit procedures to find out if the numbers are reflective of the true state of affairs of the business. So for audit opinions or for audited financials, they are more reliable than unaudited financials. So whenever you are looking for financial statements, if possible, ask for the audited financial statements. It gives you the guarantee that a third person who is an expert has double checked to confirm. Are we good? So we know the difference between audited and unaudited. Unaudited means the company has prepared the financials, but they are yet to be reviewed by that independent expert to be sure everything is in order. Are we good? So current, less than 12 months, non-current, lasting more than 12 months, cash flow, profit or loss, and then audited. Okay, let's now speak about business models. It is never possible to understand financial statements of a company if you don't understand their business model. Remember when we started today, a few minutes ago, I said that accounting is a language, and that language is used to communicate. Uh, Please don't unmute. If you do, we'll kick you out, please. Okay, if you have a question, raise your hand, please. All right. Okay, so back to what I was saying. The business is trying to communicate their result in a certain language, which is accounting. But if you don't know what the business does, you can't tell what they're trying to tell you. Why am I going through business models before showing you financial statement? Because not all financial statements will look the same. Financial statements are reflective of the underlying business model. So, okay, I'll show you an example, a few examples, right? If we know that, okay, this is how this company makes money, then when I pick their financial statement, I'm expecting to see it flow in a certain way. No two sets of financials will be exactly the same. Financials are basically using the language of accounting to communicate the result of the business to the users or the stakeholders or the shareholders, as the case may be. So we need to understand business models. Let's take some very popular business models and then let's look at how they make money. And then when you pick their financial statement, as we'll do in some examples, you'll be able to say, okay, this is how these guys make money. Then it makes sense to me. So let's first look at product-based versus service-based businesses. Some businesses deal in products. Some offer services. So for example, product-based companies, their offering is a tangible or intangible product. Walk into a pharmacy, you want to buy a painkiller. They give you a painkiller, you walk out. It's a product-based company. But these days, very innovative health tech companies are bringing services into the pharmacy, right? So you go to some pharmacies, they have telemedicine, right? You can speak to a virtual doctor. That becomes a service mixed with a product-based business. In such a case, when you are analyzing such a company's financial statements, you would notice that you cannot just expect it to just be goods because they also have services. Maybe they have other revenue streams. So go to a bank, for example. A bank is a service provider. Banks don't have inventory. They don't sell anything to you. You go to a bank, you put your money there, they are charging you to keep your money with them, right? So for product-based companies, these would have tangible or intangible products. Walk into the shopping mall, Game, ShopRite, Palace Mall, Melcom, wherever. They have tangible products. Services, basically, intangible services. So go to a firm like KPMG. You want to get audited financial statement prepared for you, right? These audit services are not tangible. It's a service they are providing you. So examples would be Apple, consumer electronics, which, by the way, they have some services, right? Because you have Apple Music, it's a service. You can stream music on your mobile phone. But let's start with Apple. Apple sells mobile phones. They sell iPhones, they sell iPads, they sell MacBooks. So if you are looking at Apple's financial statements and you go to their revenue, you're expecting to see a breakdown from what? The sale of these products. Typically, or also, Apple has other services. So, like I said, Apple Music, for example, is a service, a streaming service for music content. So, Apple's business is both what? Goods and service. Take Toyota, for example. Toyota sells cars essentially. Whatever they do in addition, after sales service, after sales repair, is still related to the car. So, Toyota is into goods strictly. Services like we have McKinsey, a leading consulting or management consulting firm globally. They are service providers. So let's touch on the revenue and then we move on. So for product-based companies, they generate revenue from the sale of physical goods or some digital products. For service-based companies, they make their money from fees for services provided, subscriptions, retainers, and the like. So at least we need to know, okay, some people make their money from goods, physical, tangible goods, some people from services. So when you pick a business model, it's bigger than just inflows and outflows. But at our level, once again, I want us to focus on the revenue streams and then the cost structure. There are many other things. You have the customer segments, customer relationships, value propositions, key activities, key partners. Forget about that. Our focus is on revenue streams for each business and their cost structure. I'll focus more on their revenue streams because that is the most important for many. How do they make money? I'm going to start with our popular Uber, Bolt, and Yango. Maybe after this session, when you are interacting with businesses, you will not just give them your money and walk away. You begin to wonder, okay, how do they make money? I'm sure everybody here has a TikTok account. Have you wondered how TikTok makes money? Because they need to make money to pay all their employees. It can't be free, right? Agreed. So we need to at least, for most businesses, know how they make money so that when you pick their financials, it will make sense to you. Let's start with Uber, Bolt, and Yango. They don't own the cars. So how do they make money? Ride commissions. Next time you are in a Bolt or Uber, you can speak to the driver and then ask, right? They take a percentage from every amount of money the drivers make. So for example, if you pay for a fare of, let's say, 50 cities, it depends on the company, but sometimes 15 and north of 20% can go to the company. So that's how they make money. Revenue stream number one. Then delivery service. I'm sure almost everybody here has interacted with Bolt Food, right? And I think Yango also has delivery services in Ghana, right? Uber Eats is in different jurisdictions where you can also order food. So for delivery services, they would charge commission fees from the restaurant for food delivery. Okay. So for delivery services, for example, the reason why you go on Bolt Food and then you see a certain restaurant listed is that they have paid Bolt a certain amount of money so they appear on the platform, on the app, so that you, the user, will see and make an order. It's another way to make money. Because I'm sure you wouldn't expect that app to be free. Like, why would a restaurant list on the app for free? And then what? How does Bolt make money to develop the app? The next is freight and logistics. For some of these ride-hailing service providers, they also have B2B. When we say B2B, business to business, okay? So they also earn revenue from business to business transport service. So sometimes if you're a company, you want some deliveries done for you in other jurisdictions, they have these services. And they have surge pricing. Have you noticed that if you try to order for a ride in times when demand is high, maybe there's traffic, the fare will be what? Absurdly very high, right? This will increase during high demand. It's an extra way for them to make money. They take advantage of the high demand and then they try and then cash in on that. So why am I doing this? When you pick Bolt's financials or Uber's financials and you go through their revenue streams, at least now you know, okay, these guys make money from these different and then a few other streams as well, right? Then out of this, they will have expenses. They will pay salaries, they will pay utilities, they will pay the developers who manage their apps for them. But at least we need to understand how the money comes in. Very important. Let's look at Netflix, YouTube, and Spotify. I'm sure almost everybody here should have a Netflix account. Either you own one or you are purchasing on someone's account. But either ways, somebody is paying for it, right? So users will pay a monthly fee for access, right? So every month you make a payment to Netflix and they give you access to content. That is how they make money. And they invest a lot of that money into generating new content, right? So we also have another stream, which is what? Content licensing. They sell rights to content for additional income. So somebody may want to host their content on a different platform. Yes, I'll charge you for that, and I make more money from that. And then ad revenue. Have you noticed on YouTube, right? If you are not on YouTube Premium, what happens is that before you play a video, they show you an advert. You've noticed, right? Or the video plays for 2 minutes and then they show you an advert. Or at the end, they show you an advert. That is how YouTube makes money. So YouTube will either charge you money to take the ads out. So I have YouTube Premium, so I don't see ads. But here's the catch, right? There's a free tier for if you don't mind watching with ads. So they don't charge you to watch anything on YouTube. You watch, but you watch ads. And the ads are paid for by people who want to place those ads to you. So how this whole system works is somebody wants you to see their business. So they pay Google, they pay YouTube, and say, show my business to users in this particular area. You can target your audience. So what you do by paying to remove the ads, like I've done for YouTube Premium, is I've told them, I don't want to see ads. You take my money. So either way is the win. If you watch for free, somebody is paying them to place the ads for you to see. If you pay them to take the ads out, every month you give them cash to not show you adverts, right? So that is it for ad revenue. So Netflix, if you're on Spotify, you pay them monthly to listen to music. So they make their money mainly from what? Subscription revenue, recurring, right? So you see their financials and it'll be different. Let's look at another example. Airlines. How do airlines make money? The obvious one is passenger tickets. You want to fly? No problem. This is their core revenue. You buy a ticket and then you fly. They also offer cargo services. So not only for passengers, if you want to transport logistics, goods across different countries and you don't want to do shipping, you can also do by air. Many of them have like business to business cargo delivery services, and then frequent flyer programs. So they have collaborations with some of these credit card companies. They can sell miles to them. In fact, many of the airlines today are operating more like financial services providers, right? Because you can use your miles to do some shopping later. Credit card, you can use the miles to fly. You can get credit card cash backs and all of that, right? So these are also ways they make money. And then premium upgrades. If you want to fly first class or business class, no problem. Pay us extra. We'll give you a nice, comfortable seat and you can fly in comfort, right? So that's how airlines make money. You can see so far, all the businesses make money in a different way. But the key terms I mentioned at the beginning stays the same. All of them have assets. They all have liabilities. They all have equity. They all have income and they all have expenses. And we'll see current and non-current for all of them. Are we good? Then the next one is, let's look at banks, probably the most interesting. How do banks make money? Actually, banks make money from your money. Without you, there's no them. So the first is interest income. Banks earn money by lending and charging interest. So the money you give to the bank, they lend to somebody else and charge higher interest than they give you. So the bank can give you just 1% in interest on your account and charge someone probably 30%. The extra 29% is for them, free money. So actually, you giving the bank your money is a way they make money. Because when the money gets to them, they give it to someone else and charge them interest, right? So if everybody decides not to deposit at the bank, there will be a big, big issue. They use your money to loan to other people. Then they have transaction fees. I'm sure you've noticed that every month they send you something, e-product something, or you have an ATM card, something, they'll charge you for something. They charge you fees for their various banking services. They also make money from that. If you are transferring money to someone else, there's a transfer charge. They make money from that as well. Some banks offer investment banking services. So they charge fees for advisory services to high net worth individuals and some specific clients who are called the wealth management clients. Then they have their net interest margin, like I said, difference between the interest they earn and what they pay to you on your deposit. Then some banks who have credit cards, they earn interest from what? Unpaid balances, and credit card fees can be very high. Then some banks have trading divisions, so they make money from trading stocks, bonds, foreign exchange, right? So you can see the way banks make money also very different. Then let's look at insurance companies, right? Especially banks and insurance, their income statement looks so different from everybody else. So when analyzing, you'd notice they are quite different. Okay. How would insurance companies make money? Their model is quite interesting. They take premiums from you. So let's say if you are here and you have a car, you either have a third-party insurance cover or a comprehensive cover, right? And you pay for the premium. So the premium is what you're saying, dear insurance company, here's my money, take it, and then cover me, protect me. So this is their primary source of income for coverage. Then insurance companies also have insurance companies. As in, insurance companies also pay other people to what? Cover them. So if you are a reinsurance company, then you can even make money from other insurance companies insuring with you. And then policy fees. In terms of policy fees, this is additional income from charges for policy modifications and late payments. You can come and say, I want to move from this policy to that policy. They're like, okay, no problem. It will cost you X amount of money to cancel. They make money from that. And then investment income. Obviously, when you give your premiums to them, they would invest it. They can't loan it to somebody like the bank will do, but they'll invest and make more money just in case you come and make a claim and they'll have more money to pay you. So the insurance companies make money from investment income and then underwriting profit, right? They basically manage risk and minimize claim payouts. Every insurance company's dream is you bring them all your premiums and nothing bad happens to you during the year and you don't make a claim. That is their dream, right? So most of them bank on the hope that everybody who has made a claim, maybe you're going to make a payment for your car insurance cover. They are praying you don't get an accident. And if you do, it should be very minimal. So they are hoping that if they have 100 customers, maybe 5 or 10 should make a claim. Then 90 left should not make any claim. And that's how they make their money. So if all insurance customers are to make a claim, the sum assured is almost always bigger than the premium. The insurance company might collapse. Right. So they are just hoping that's their model too, just to show you the unique nature of how businesses make money. Then let's take a retail. This is the last example, a retail business. Retailers are quite simple. They buy from the wholesale at wholesale price. They add their margin and sell at retail price to the customer. That's all. They buy from the wholesaler at wholesale price, add their margin, sell to the customer at retail price. That is all. The difference is their margin. It's called a margin. Margin is an English word that means gap. The gap between two things. So the margin, right? So we would have something called gross profit. I'll come to that shortly. So they get their gross profit after taking down their costs, direct costs. Then what is going to happen is you're going to take out their expenses, and then what is left is their profit. Okay. So with this understanding of business models, let's now go straight into content of a typical set of financials. At least we've seen the basic terms. We've seen some business models. So we have the understanding that if I want to understand the language being spoken in the financial statement, I need to know what the business does and how that business makes money. So that I'm expecting, even before I see the numbers, I know, okay, an airline sells tickets. So I'm expecting something on ticket revenue, something. I know that's how they make their money. If I pick Netflix financials, I know they get their money from subscribers. So I'm expecting something on subscription revenue, right? So when you pick a typical set of financials today, there are 5 key elements. There's something called the balance sheet. It's also known as a statement of financial position. I'll show you how a real one looks like shortly. Statement of financial position. We have the income statement, which is also called the statement of comprehensive income. We have the statement of changes in equity, the cash flow statement, and then the notes. This is very important for a beginner. Notes to the financial statement will give you additional context, which you may not find in the main financial statement. So the notes are an integral part of any financial statement. When we are done, we'll take some financials and then we'll try, right? So instead of all the 5, which is what? Balance sheet, income statement, changes in equity, cash flow, I'll focus on balance sheet, income statement, cash flow. These are the 3 you need to understand in order to understand the business. In fact, Changes in equity is just a statement explaining how equity has moved over the year. So for a beginner like you, let's focus rather on the three main ones: balance sheet, income statement, cash flow. I hope you remember the element you started with. So the balance sheet just shows you your assets, liabilities, and equity. That's all. If you joined early enough, we explained what assets are, what liabilities are, and what equity is, right? If you pick a balance sheet, it just shows you these three items. That's all. So every balance sheet shows you the company's assets, its liabilities, and its equity. Every balance sheet, anywhere in the world. Go to the USA, go to Australia, go to Ghana, go to South Africa. Every balance sheet anywhere in the world shows you these three. So since you know what assets are, since you know what liabilities are, since you know what equity is, since I've told you that current means less than 12 months, non-current means more than 12 months, then it means when you pick any balance sheet today, what are you going to find on them? Assets of the company, its liabilities, and its equity. Let's come to the income statement. I also explained revenue or income to you, right? I explained expenses, and I told you there's something called profit or loss. So the income statement shows you the company's revenue or its income, all its expenses, and whether they made a profit or loss. Simple, at a very basic level. So we have now covered the five elements you started with. Assets, liabilities, equity can be found on the balance sheet. Income, expenses, and profit or loss will be found on the income statement. How about the cash flow statement? Well, in accounting, cash is an asset. I mentioned this when we started. So the cash flow statement is just a special statement explaining that particular asset of cash. That's all. Every cash flow statement takes the cash the company has and then says that this is going to what? Explain how the cash came in and how the cash went out. That is all. For a beginner, these are the three main statements: balance sheet, income statement, cash flow. Like I said, we have changes in equity and we have notes, but for a beginner, we'll come to that. Your focus should be on these three main ones. So let's take the balance sheet. It is also called the SFP. SFP means Statement of Financial Position. If you remember when we started, I told you that your equity equals assets less your liabilities, for those who joined very early. So the balance sheet or the statement of financial position only shows you these three things in an equation form. So it tells you that your basic mathematics from junior high school, if you want to rearrange this, you can say assets will be on this side, equity plus liabilities when equity goes to this side. And that's what we have here. So your assets equal the sum of liabilities plus capital. And in fact, don't try to even memorize it. Every business's assets are financed either from outside help or from the business's own equity. That's all. You either go for a loan or somebody else loans you, or you buy goods on credit as a liability, or you, the owner yourself, you finance everything with your own equity. So every business's assets will either be debt financed or equity financed. That is the accounting equation. Let's take a look at the model SFP to at least practicalize what we are doing today, because we want to learn how to read financials, right? So here you are. This is a real financial position, a balance sheet. Now, every balance sheet you pick, I want you to look out for the following items. You'll see us at a certain date. It means it's the position at a point in time. Balance sheets are also known as snapshot statements. They show you how things are as at a point in time, right? Do you remember I told you balance sheets show you three main things? So let me highlight them for you. Your assets are here. Your equity is here. In fact, equity and liabilities are here. So equity and your liabilities. I hope you also remember I told you there's non-current versus current, but we'll come to that. Whenever you pick financial statements, first thing to look out for is what are you looking at? This is a statement of financial position. You're like, okay, this is the statement that's supposed to show me all the company's assets, all its liability, and all its equity. So yeah, that's my balance sheet. Next thing is ask yourself for the date. What date is it for? So they'll tell you the company's year end, 31st December, whatever year. Every published account will give you at least 2 years. That's a norm, 2 years. So you get the current year's numbers and you always get the previous year's numbers for comparison's sake, right? So you can see it's 20XX and 20XX minus 1. That is the previous year. So anytime you pick financial statement, I'll show you real ones. You'll notice that they'll give you for the balance sheet, the assets, liabilities, equity, this year's numbers and previous year's numbers every time. So you can tell how the numbers have progressed, have moved over time. Third thing to check is the currency. So this is in USD in million. It means when I see 822 here, I should read as $822 million, not $822. So always check the currency. Some might say USD in thousands. Always check what they will tell you in advance, clearly stated at the top. It's your job to find out, is it millions of dollars, thousands of dollars, millions of cedis, millions of pounds, whatever, the currency will be stated clearly. And this guy in the middle here called notes is designed for people like you who are trying to learn for the first time. It means I don't want to bore you with the details. If you want to know all the property, plant, and equipment this company has, go to note 5. It will be at the back of the financials. So you just have to scroll through and go to 5. Note 5 will break down the makeup of this H22 for you. That's all. Very basic. So the note to the financial statement will just give you additional context, additional breakdowns, which we may not have the time and space to show on the main financial statement. Are we good? So far, the title or the heading, the date, the currency, the years, which will mostly always be 2 years, and then the notes. Once you identify these, you can start speaking the language of accounting. Remember, I told you for assets, we have current and non-current. If you remember, I said non-current lasts for more than 1 year, current lasts for less than 1 year. So it means for this company, let's come here. It basically means that non-current assets, these are their assets that they have, that they expect to be in the business for more than a year. Current assets, these are the assets they have that they expect to be fully utilized or realized or last for just a year in terms of the frequency. So example, it means that they have property, plants, and equipment. These will be their buildings. If they're a manufacturing company, they are plants, right? If they have any land, it's going to sit here. If they have vehicles, it will sit here. Any tangible asset. And obviously, nobody's land is expected to last for less than a year. A land is expected to give you value for more than 1 year. Remember, we said assets are things you own or you control, which are expected to bring value to you. So if you have anything, buildings, land, motor vehicles, furniture, that you expect to last for more than a year, it will be under property, plant, and equipment. At least now we understand that, okay, when I pick my asset, I'm expecting to see non-current and then current. Intangible, when we see intangible, basically means things you cannot see and touch. So property, plant, and equipment are basically your tangible assets. Tangible means you can touch them. They have a physical substance or a physical presence. You can touch a building, you can touch a car, you can touch what? A land if you want to, right? Those are your tangible assets. Intangible assets are things like software. You can't see software with your eyes. Copyright, patent. These are all intangible assets. So it means that they have assets that you can't see with your eyes. Worth 39, but it's 39 what? $1 million, because this financial is in dollars, in millions. So it means this company has $822 million of property, plant, and equipment. We'll find the details in year 5. But 822 is for the current year. Last year, they had 757 million in land, building, cars, furniture, all of that. Do we understand? Then we have trade receivables. Whenever you see receivables and there's trade attached, it basically means your debtors at a very basic level, right? If you're a chartered accountant here, this session is not for you. It's for beginners. We can have, yes, trade and other receivables. Here I'm talking about the very basics. Typically, when you go to note 8, they'll let you know if these receivables are from just trade. When we say trade receivables, these are people who bought from you and didn't give you cash. So we have $454 million of cash sitting out there yet to be collected. It means we've sold to some people $454 million and they've not paid us yet. Interestingly, last year it was zero. If you are a shareholder of this company, you should be very worried. Wouldn't you be? Let's assume you're a shareholder here. Last year, everybody who bought from you paid you in cash. Why is it that this year $454 million is uncollected? Right? And to make matters worse, this is a non-current asset. So it means these guys have been owing us. This should not make sense, right? Technically, we expect them to what? Pay back in more than a year. Receivables are typically current. But once you have a trade receivable non-current, it means you expect these guys to pay for more than 2 years, maybe based on a contract. You told them that they can pay back in 2 years' time, whatever. So it's more than a year, right? Ignore deferred tax assets. It is not at your level. But if you are an accountant, I'll say IAS 12 talks about temporary differences and all of that. But yeah, at this level, ignore that, right? So your non-current assets are talking about assets you expect to realize or have or bring value after more than 1 year. Then current assets are the ones you expect to realize or bring you value within 12 months, less than 12 months. Inventory is basically your stock of goods. Whatever you are dealing in, if you are into the sale of cars, your cars will be your inventory. If you are into the sale of bottled water will be your inventory. If you're a company like Nestle and you go to Nestle's balance sheet, you see inventory. It is the Milo, the Nido, the Ideal Milk. All of those will be their inventory. So whatever you deal in, right? Now, since this is in thousands and this is in millions, this is 2.13 billion with a B, right? They are saying every number you see here is in millions. So all it means is that in your mind, just add millions. So that is 0.00000 to every number you see. So if you do this, it means 0.00000 becomes 2.13 billion. So whatever number you see, if it says in millions, millions means add what? 6 zeros. If it's in thousands, add 3 zeros. Right? So this is how to read it. Oh, inventories, they have over $2 billion of inventory on their balance sheet. Last year it was 1.57 billion. It means they have a lot of goods that have not moved, or maybe they manufactured more, they bought more. Trade receivables, like I said, these are your debtors. So those who have bought and haven't paid you yet, right? This fell from 10.4 billion to 8.6 billion. Then receivables from related parties. Related parties are people you have a special relationship with at your level. So it can be maybe companies that are within the same group. Companies within the same are all related parties, right? Then obviously cash and cash equivalent. This basically means cash and anything close to cash at a beginner's level. Cash itself and anything close to cash. So your bank balance will be sitting here. Short-term investments, like a 90-day treasury bill, will also be sitting here, right? Because they are cash or they are near cash, right? So this is our non-current and our current assets. Let's now come to liabilities. The same way we have non-current assets and non-current liabilities. Sorry, we have non-current assets and current assets. We also have what? Non-current liabilities and current liabilities. These are the amounts that we are supposed to pay someone, and we are expecting to do so after 12 months for the non-current and within less than 12 months for the current. So, for example, long-term borrowings, this can be a 5-year loan. I've gone for a loan for 5 years. It is non-current. I know I'll pay back in 5 years. So I put under my non-current. Anyone who picks the financials knows that, okay, I expect this $88 million to stay on the financials for at least more than 12 months, right? And then we have retirement benefit obligations. You are not an accountant. I would have mentioned something called IAS 19, but I don't want to bore you with the details. See it like people in the organization that you have to provide for their pension. At some point when they retire in future, it will definitely be what? Long-term, more than 1 year. Then, like I said, current means less than 12 months. So trade and other payables. These are people you have bought from, your suppliers. you've not paid them yet, but you expect to pay them within the coming 12 months. And you can see it's in note 15. So if you had gone to note 15 of this financial, you find a breakdown of this. So the notes are very important, as you can see here. Right. Then we have short-term borrowings. Maybe you've gone for an 8-month loan, or maybe an overdraft from your bank. You're like, oh, bank, I need some 30-day overdraft to do some importation. It's a short-term borrowing because you expect to pay within 12 months to be here. So if you are someone analyzing numbers, you have to say, okay, this company has borrowings they expect to pay back after a year, and they have borrowings they expect to pay back within a year. That is why when we started, I explained non-current versus current, because you see it on almost every balance sheet, except some people like banks, as we'll come to shortly. Then income tax payable, right? If you are joining us from Ghana, obviously this is what you are supposed to pay GRA, that you are yet to pay, but you expect to pay within the coming 12 months. So ladies and gentlemen, this is how a standard balance sheet looks like. We've seen all the elements. Oh, I forgot equity. Remember I said equity is just the difference between your assets and your liabilities. So if you have a calculator here, let's all practice. It should be, so total assets is 15,078, right? So let's take out total liabilities of 4,916. It will give us 10,162. Try it on your own. Take your phone and calculate it. When you take all your total assets, this line, subtract your total liabilities, this line, it will give you 10,162, because we said what? Asset minus liability equals equity. So all any balance sheet does is to show you three things. Assets most likely broken down into current, non-current, liabilities broken down into current, non-current, and then equity. Equity, we can just touch on share capital. This is what, or the number of shares in value that the owners of the company have. And here's over $1 billion in equity, share capital. We also have retained earnings. To retain means to keep something, right? So retained earnings will basically be the earnings of the company that have not yet been distributed. So if a company makes profit and doesn't pay out dividends, you'll see retained earnings here. So this is 8.7 billion. This is money they have available to what? Distribute if they want to. But some companies are in a perpetual loss-making position. So you might see a loss over here. It will be a bracket. So whenever you see a bracket under retained earnings, it means the company's surplus, or the company has a deficit rather. They've made losses, and the losses are now eroding their capital base. So this is our balance sheet. I believe we can proceed now. So let's go back to, I'll take questions shortly, right? If you have any. Let's come to the income statement. It's also called the statement of profit or loss and other comprehensive income. Statement of profit or loss and other comprehensive income. If you recall, I told you that whilst the balance sheet shows assets, liabilities, equity, the income statement shows income, expenses, and any profit or loss. So ideally, you are looking at your revenue, which is the money you make from your core business activity. But I'm sure you are aware it's not only your core business you make money from. If you are a business and then you sell an asset and you make a profit on that sale or the gain on that sale, it's not revenue. You're not in the business of selling assets. Let's say Unilever Ghana Limited. Unilever doesn't sell assets. But if Unilever sells one of their cars and they make a profit on that sale, maybe they bought the car for 3 million cedis, sold it for 6 million, they've made a gain of 3 million. That 3 million gain will come as other income, but it will not be revenue. Revenue is from your core business activity. So Unilever's revenue will be from the sale of the soaps, the kitchen ingredients they prepare for us, all the different Unilever products, cooking oil. Sale of those gives them the revenue. There's something called cost of goods sold. Some just call it cost of sales. Cost of sales is basically the amount of money you have to incur to generate your revenue. These are your direct costs. So I'll give you an example, very practical example. You sell wigs, ladies' hair, like ladies' natural hair, or ladies' wigs on Instagram. You bought your wigs for, I don't know, maybe 10,000 cedis, a lot of them. You sold everything for 30,000 cedis. This is your revenue. This is your cost of sales. the cost of the wigs. But you see, to get your wigs to customers, you probably need to get a dispatch rider to deliver for you. Or you have to pay some utilities. You need to pay for internet. All of those will be your operating expenses under this expense line. Follow carefully. The wig seller bought the wigs for 10,000. She sold it for 30,000. The 30,000 is her revenue from selling wigs. The 10,000 is her cost of the wig. So when you subtract, she makes something called a gross profit of 20,000. The gross profit is the difference between your revenue and your cost of sales at a very basic level. But don't forget, I mentioned business models. When you pick a bank's income statement, you will not see revenue and cost of sales because banks don't sell anything. That's why we spent time discussing business models. When you pick a bank's income statement, there's no revenue, there's no cost of sales. They are there, but with different names because banks have a different business model. So I'll show you EcoBank's financial statement when we get to the end. Are we good? So this wig seller makes a GP gross profit of 20,000. She has to pay utilities of 1,000 cedis. Maybe she has a few people who assist her salaries, also 1,000. So let's assume total cost will be 2,000. Out of her 20, she has 18,000 left. This is her profit before tax. She has to pay GRA some money on this income. You take out your tax, you have a profit after tax. I'll show you a full P&L, don't worry. So you can see here, it's mainly about incomes and expenses. No assets are here, no liabilities are here, no equity is here on the income statement. Let me show you another model. This time, let's look at the income statement. So, statement of comprehensive income, which is the income statement. This is shown, once again, the same elements I taught you here. The dates, currency, years, notes, and the title. What are you looking at? So this time around, they are telling us that, all right, this is a statement of comprehensive income. Okay, so I know this is an income statement. But one thing you should note is this one will say for the year ended. It will be the same anywhere in the world. So don't worry. A balance sheet will always say as at, because I told you it's a snapshot statement. It tells you that as at 31st December, year end, these are the assets we had, liabilities we had, equity we had. I like to explain to beginners that a balance sheet is the selfie you took on your phone. At that point in time, that is your balance sheet. The P&L is how you have changed from selfie to selfie. So let's say in January, you took a selfie on your phone. You had short hair. In December, you took a selfie on your phone. You had grown your hair. The income statement shows the movement, all the different selfies put together. But the balance sheet will be the last selfie you took at year end, the one with long hair. So when you look at the balance sheet, it will show you the final selfie of the year. But the P&L shows you all your selfies put together. Does that help? So balance sheet is snapshot statement. Income statement is over a period of time. So here it means that during the whole period, this is what we made in income and what we made in expenses. Are we good? So this is the title, comprehensive income. What is the period? Year ended December 20, whatever. I told you they'll always give you at least 2 years. You might see some financials with a third year. Typically, when the third year comes in, there's something called a restatement, right? Accounting has something called IAS 8 above your level. It may require certain things to be restated and represented. But at your level, don't worry, you'll see your standard 2. If you see a third one, they might write beneath it restated. Just remember, it's the one I said, they may try to correct a previous year's mistake and represent something, or they change a certain accounting policy. And accountants are required to apply policies in a way called retrospective. But don't bother about that at this level, right? So once again, we have 2 things here. Current year, income and expenses. Previous year, income and expenses. And oh, I forgot to mention, the entity's name will always be mentioned. This is ABC Corporation. This is also ABC Corporation, right? Their balance sheet and their income statement. Once again, the currency is in USD in millions. So it means every figure I see here is in millions of dollars. Then I'll have the notes as well. It means if I want to see the breakdown of revenue, I should go to notes 2. Every published annual report has these features, standard. So that's why I say when you pick them, you'll not be lost. you have an idea. Like you will not be a stranger in the books. Like you know, okay, I'm looking at this. Now watch this one carefully. It means that we have revenue of 28.9. This is what will be in billions, right? We incurred cost of sales of 19.3. So remember the lady who is selling the wigs I mentioned. It means you made sales of 28.9. It cost you 19.34 to get those things you sold if you are into goods, and you made a gross profit of 9.6. Your gross profit is before you deduct any other expenses. Cost of sales is your core expenses. I won't bore you with the details. Like if you go into the notes, you see your opening inventory, you add your purchases, you less your closing inventory. There may be some cost attributed to cost of sales, but no, we are beginners. So let me not go there. You can even have depreciation charged to cost of sales, but it's fine. Let's not stress. So revenue is your how much you made from selling. And once again, remember that I said based on business model, this revenue can come from what? Services. If you're a service provider, that is your revenue or your inflows from what? Whatever service you are into providing. Take out your cost of sales, you get your gross profit. Then you can now deduct your expenses. So this business had to pay some money to distribute or deliver goods to customers, distribution expenses, 5.4. Admin expenses, 1 billion. So here, typically your employee cost can sit here. Employee cost, office cleaning expenses, utilities, right? Audit fees, tax consultants fee, they all sit here. Distribution, if you are into, let's say, a delivery, you are into a B2C or B2B business, right? And let's say you have a van that delivers for you, fueling the van to deliver your goods for you with distribution costs. Then other operating income. You remember I told you that Unilever does not deal in cars. Okay? Unilever. So if Unilever sells one of their cars and they make a gain on that sale, it's not coming here. It's coming to other operating income. And you can see it's usually smaller. Many businesses, you see other income is much smaller than the because revenue is like what you really do. Why were you set up? Other operating income is okay. Did you make any other money during the year? So let's say, let me give an example. There's something called FX gain. FX basically means foreign exchange. If you've been following news for a while now, you notice that the Ghana cedi has been performing poorly against international currencies, right? So you'll be making FX losses. If you make an FX gain because maybe the cedi performed better against the dollar, that FX gain comes to sit here, right? It is not, for some people, we put under finance income. You can finance cost or income. It depends. You are at liberty to present. But my point is that you making money because the currency appreciated doesn't enter your revenue. You are not in the business of dealing in foreign exchange. So that is like an other side income you got, right? So once you add your other income, other operating expense, you get your total operating expenses. Some people might refer to this as PBIT or EBIT. So let me explain what that means. The P stands for profit, B is before, I is interest, and T is taxes. So profit before interest and your taxes, or earnings before interest and your taxes. So once you have your EBIT, you're like, okay, this is the money. I meant to refer this one rather, operating profit, this guy. Once you have your operating profit, it means, okay, after paying all my expenses, excluding interest to those I borrowed from, and taxes to the authorities, this is how much profit I made for the year, 3.3. So out of the 28.9 we sold during the year, after paying my direct cost of sales, paying the distribution cost, my salaries, everything, utility bills, whatever, I have 3.3 left before I pay my finance costs and before I pay my taxes. Are we good? So finance costs can be as basic as what? Interest on a loan. So you go to a bank, the bank charges you interest, they charge you a facility fee, an arrangement fee, whatever, for that particular loan. You take that one too out, you have your profit before tax. So that is basically 3334 minus 23 gives you this. Now the 3311 is how much you have before you pay GRA for the year. Once again, in accounting, this line is not what you really have to pay GRA. because there are some things we call movement in deferred taxes that might enter here, but it is not at our level. Don't worry about that. Just see this line as whatever has to go out as taxes. It may even have an under or over statement of tax for the previous year. But at our level, you take out your taxes, you have your net income. This is what you have available for your shareholders. You've paid everybody. You've paid everyone. You've paid the bank. You've paid the tax authorities. You have 2.9 left. So out of 28.9, you can see how we went through everything here. And technically, everything on this screen is either an income or an expense. Revenue is basically your income from core business activity. That's all. Right. Then the reason why it's called statement of comprehensive income is that after the main income statement, there are other items we call comprehensive income items. At your level, it might be a little bit, let me put it this way, right? They said you don't understand something if you are not able to explain to a beginner. So let me try, right? Okay, so other comprehensive income is not from your daily business activity. These are special things that the accounting experts want to be separated from this. See it like that at your level. So the accounting experts have something called accounting standards. We have IFRS. You would definitely see IFRS in many of the financials. It means International Financial Reporting Standard. Do you remember I spoke about language when we started? And I spoke about assets, liabilities. Good. The IFRS is a set of what? It's a whole language, set of rules. So the same way we have what? English language. Some people speak more fluent English than other people. IFRS is like when you have really mastered the language and you now know specific rules, right? I've been speaking IFRS for over 10 years now. So my point is that the accounting experts have created certain rules and they say, you know what? Some things are there, put them after the P&L. Because I want the investor to know that, okay, from my core business, I made 2.9 core business. But when you come here, you can see unrealized loss from foreign currency translations. This can even be from a foreign subsidiary. So you have another company you own in Nigeria. The Naira is performing poorly. You made a loss in Nigeria. That loss from Naira will not come here. It's not about Ghana's business. It might appear in OCI. Then there's something called revaluation, right? Revaluation of assets. Let's say you have an asset that was worth 1 million. Today, its value is 3 million. There's a revaluation gain of 2 million. IFRS says put that revaluation gain after P&L. There's a standard called IAS 16. IAS is International Accounting Standard. Are we good? So just see you see the OCI in many financials. See it as, oh, it's the section after the main income statement where Michael said the accounting experts say we should put certain special things. Once you begin to take accounting seriously and you start to follow that journey, it will start to make sense to you. But at this level, it's a special place where experts want us to take some things that are not like core business, and they are special rules. So if you remember, I showed you this retirement benefit obligation. It's a special rule called IAS 19, employee benefits. It says that if there's any gain or loss on remeasurement of your pension assets and liabilities, bring it here. Why do I know? Because I can speak IFRS. So my point is that it's just a place where we take special items that the experts say we should take. That's all. Okay, your core income is this. But at the end of the day, we actually add your OCI, other comprehensive income as OCI, to your profit to get your total comprehensive income, TCI. So actually, this is how much we made for the whole year. Right? That's how much we made for the whole year. So back to this, we've seen the balance sheet, income statement, and then let's look at the cash flow. The final of the top three I mentioned. Now, remember I told you cash flow just measures one thing, the asset of cash and cash equivalents, to be fair. This is just one statement that says, where did your money come from and how did you spend it? That is all. So we have, you see, cash is so important. We have a whole statement dedicated to explaining cash. There's a full statement dedicated to explaining cash. Now, if you're an investor in a company, your eye should be very much on this particular statement. Because remember, I told you that profit or loss could have a lot of goods sold on credit. You wouldn't have the cash if you want to pay salaries today. So your cash flow statement is this. It has 3 sections. Just remember O, I, and then F. O stands for operating activities. I stands for investing activities. F stands for financing activities. All the cash flow statement does is it shows you the cash you had at the start of the year, what you had at the end of the year, its movement, and the movement broken down into how much went into operations, how much went into investment, how much went into financing the business. I'll explain them shortly. So cash flow statement explains just one asset, cash and cash equivalent, broken down into 3 segments, OIF, operating activities, I for investing activities, F for financing activities. So let's see the model cash flow statement. So as you can see, as usual, just like everything, cash flow statements will typically say for the year ended, right? Indirect method is the one you see in financials. We have the direct method, but let's leave that for a beginner. This is the cash flow you see in almost every financial statement out there today. As usual, you have your notes, you have your currency, dollars, million, you have current year, you have previous year. It's not going to fail. I told you there are 3 sections, O, I, and then F, right? So operating activities is here, investing activities is here, and your F financing is here. And I told you the cash flow statement tries to measure the movement in cash. So let's try an experiment, okay? How does the balance sheet link to the cash flow statement? So let's come to the balance sheet. What is my cash at the start of the year? Right? Is it the same thing? Will it be the same? Or that different template? 7931248. Okay, perfect. So look at something for me, right? Let's all look at this. Can you see the cash and cash equivalent? Let me just highlight that whole line for you. This is your cash. You can see is what? Current year is 1248. Last year is 793. The cash flow statement takes just this line and wants to tell you what happened between 793 and 1248. That's all. It's a whole statement dedicated to telling you the story between what moved me from 793 to 1248. So let's go and see these numbers here. So cash flow statement. Have you noticed? Cash at the start of the period, 793. End of the period, 1248. Do you remember from the balance sheet? These 2 numbers, we just saw them, right? So this whole statement is telling you that, okay, what happened between 793 and 1248 was an increase of what? 455. Now that 455 is explained by operating activities, investing, and then financing. That is all. Now for the cash flow statement, you see numbers with a sign. So either bracket means outflow of cash, no bracket means an inflow of cash. So I'll give you an example. If you see purchase of property, plant, and equipment, bracket 370. Oh, we spent $370 million in actual cash to buy property, plant, and equipment, lands, motor vehicles, whatever, furniture, right? Then 237, no bracket. I said no bracket means inflow. So this is the proceeds from the sale of PPE. It means that during the year, we sold some of our assets and made 237 million. This is the key thing for cash flow. Bracket means outflow, no bracket means inflow. Remember, we are trying to explain the 455. Right. So there are some things you see under operating activities called adjustment, working capital adjustments and all. Honestly, I would say that is outside the scope of our discussion. Right. So back to this. What would you find under operating activities? Pretty much anything linked to business operations. In the notes, you see a breakdown of operating activities for longer than this, right? Then investing activities have to do with your assets, mostly non-current assets. The one I told you that lasts for what, more than 1 year, right? So these assets that last for more than a year, how much money did you make from them and how much money did you spend acquiring them? That's all. Investing activities, whether tangible or intangible. So you can see purchase of PPE. We bought $370 million of assets. Intangible, 4 million. Bracket, it means we spent $4 million to buy maybe a software. Proceeds from sale of PPE, 237, no bracket. We got $237 million in cash. This statement is pure cash, okay? From selling our assets. Financing activities is basically your inflows and outflows from raising money for the business, whether it is debt or equity. So proceeds from issue of share capital is zero because we didn't make any money from issuing shares this year. But repayments or proceeds from long-term borrowing, it means in this year, we paid $31 million to our bank in terms of our paying off our loan. But the previous year, we went for a loan of 72. Why? That's why there's no bracket. 72 no bracket means inflow. So $72 million came into the company as cash from a loan. And then in the next year, we paid 31 million of it off. Dividend paid, because it is paid, it will have a bracket. So it means we paid over 2 billion in dividend in the previous year. This year, 2.5 billion to our shareholders, right? At your level, this is the cash flow statement. It shows you the movement in cash. When you add your operating activities to your investing activities, to your financing activities, it should give you the net cash for the period. Let's try it. If you have a calculator, right? So I hope it does. 3123 minus 137. This is an old statement. So minus 2531. It gives me, yes, 455. Try it and see. When you add O plus I plus F, it gives you the movement in cash. So adding positive 3,000, negative 137, negative 2531, give you 455. So the cash flow statement is basically a statement explaining how your cash moved from start of the year to end of the year and breaking down that movement into OIF, operating, investing, financing. That is our cash flow statement. And I think we also have, I put changes in equity here. This is not a major statement for you at your level. It's just telling you how your equity moved throughout the year. So let me show you something. What is the total equity here? As at this year, 10,162. Can you see? 10,162. Where's our balance sheet? Do you see? Good. Do you see this guy here? 10,162. So statement of changes in equity is just another statement showing you how that equity has moved. You might not have too much need for it as a beginner. You will see dividends paid there because dividends will be deducted from retained earnings, right? But my point is that changes in equity, you can see this 10,162 is going to tell you that 10,162, it has headings: share capital, retained earnings, revaluation surplus, total equity. When you pick a bank's financials, you see other equity items there, like some statutory reserves. Okay. Other companies might have share-based payment reserve or other components of equity, right? But basically, this, I would say, you can see retained earnings. How does the P&L link to this? Basically, you start with what? Your year, your balance. Then your net income for the year, 2593, will be brought to this. So let's go and look for 2593. Right? Where that is this one for the previous year. Right? So that profit goes to join your other reserves and it grows your retained earnings. And out of that, you make a payment of dividend. We pay dividend of 2.5 and 2.01. Let's see, I should find exactly the 2001 dividend is here from retained earnings. It was taken from here, and the 2.5 also taken. But like I said, my focus was not on things in equity. Income statement, balance sheet, cash flow. I can bet everybody here is an expert. So let me just wrap up with real financial statement and we'll take questions, right? Actual real life statements. Although we've seen a real one. So this is GOIL. Everybody in Ghana knows Goil, right? So for Goil, this is their income statement. Once again, you can see it has this. This is their real annual statement, right? Like I said, their actual from their annual report. So here we have, sometimes they'll show you group and company. Group is like the entity and other related entities within a group of companies. So that will be called the consolidated numbers. As you can see, consolidated. It's always bigger than the company one because there'll be other entities also added to this. But at a basic level, it means Goyle made gross revenue of 21. This is in what? Thousands. I told you, check the currency. You see this year, you see last year. So 23 and 22. You see the currency, you see the notes. So they made gross revenue of 21.7, and they had to pay customs duties and levies of 1.1, leaving net revenue of 20.6. Then Goyle incurred cost of sales of 19.8, which is what? The fuel cost they had to incur, whatever cost. Then after subtracting cost of sales from their net revenue, they made gross profit. Then they had some sundry income, which they're telling us to check note 3 for the breakdown. Sundry income will be what? Other income. They probably sold one of their stations, made an income or made a gain. Then we have the depot and station expenses. Then staff, selling, and admin expense, so employee cost and all. Then they had their operating profit before financing cost. Then they took their financing cost. So this is their EBIT, right? The one I called PBIT or EBIT. Then they took their finances out, profit before tax. They are supposed to pay what we call the growth and sustainability levy by government. So they took that one too out and took their taxes out. Then they had their net profit for their shareholders. Do you remember I told you there's a guy called other comprehensive income, where I said accountants have special rules on what should go there, right? So you can see they also show their OCI, gain or loss on fair value through OCI instruments. This is under something called IFRS 9, way above your level. But at least you know that, okay, this is Goyle's operational results for the year. Then what the accountant like to put in their special place, giving us their total comprehensive income. Then for some listed entities, you're supposed to show your earnings per share and your dividends per share. It's a requirement under accounting language, which we call IAS 33. Okay. So this is how a real one looks like. At least this should make sense to you, right? Let's take Goyle's balance sheet. As usual, all of you are experts now. Goyle has what? Non-current assets. You're like, okay, these are the assets of Goyle we expect to last for more than a year. They also showed us the currency and then the year, 22, 23. Then we have current assets. Oh, these are the assets of Goyle we expect to last for less than a year. Then Goyle also has equity, and Goyle has non-current liabilities, the ones they will pay after a year, and they are current, the ones they will pay within a year. So looking at Goyle, they have property, plant, and equipment, intangible assets, right of use asset. These are for leases. Maybe they lease some of their stations. Remember, I told you that when we're defining asset, I said either things you own or you control. So they may not own the station legally, but they have control over it, right? Then some investment that they have that will last for more than a year would also be stated here. Then their current assets, things they expect to last for less than a year, their inventory. This will typically be the fuel you buy from them, the fuel at the fuel pump. And when you go, you can buy lubricants from them, such as what? Maybe your engine oil, 0W20, whatever, your transmission fluid. They sell all of those. They are inventory for them. Then trade and other receivables. Those who have bought from Goyle and haven't yet paid them. You might wonder if it's possible. It is. You are a retail customer. You go and you pay in cash. But the big companies buy fuel in bulk from them and pay them later. So as at year end, when they took the final year end sell fee, do you remember the position, right? As at, this was what was there as unpaid. Then this is their cash and bank, how much they have in their bank. So it means all of us can see it as we speak today. Well, as at end of 23, Goyle had 210 million Ghana cedis in their bank account. That's a lot of money, right? As at December 23, they had 210 million cedis sitting in the bank, cash and bank. Right? That's a very good cash balance. If you check, it rose from, for the group, 71. So something happened this year. They had a very good year. to have this much cash sitting in the bank. So their cash flow would explain the movement from the 71 to the 210 when you check, right? Then this is their equity, stated capital, retained earnings. And I told you there could be other what equity items. So they have something called a building fund. If you go to note 18, they will explain it to you. You see, so the notes are there to give you that further clarity and context. They have a capital surplus account. You can go and check their notes 20. Then there are non-current liabilities. They have a non-current term loan. It means they have some 62 million CDs with a certain bank that they expect to pay after a year, maybe 3-year loan, 7-year loan, whatever. But they also have a bank overdraft. So they also went to a bank and said, okay, you know what? Give us some 350 million to run operations quickly. They have trade payables of 2.7 billion, right? This one is people they have bought from and they haven't paid. Maybe they bought fuel from somebody and they are yet to pay. Then current tax, what they have to pay GRA within the coming 12 months. And then the current portion of their term loan, the portion of the loan they've gone for, the long-term loan here, right? Which is due within 12 months. So typically, some of these liabilities are broken down into current and non-current portion. So it means the long-term loan, they have 11.7 million due in the coming 12 months, with the remaining 62.2 due in a period after 12 months. So this is for GOIL. You can look at any company's financials. This is the cash flow of GOIL. So if you come to their cash flow, let's look at something. Do you remember these numbers? 210 and then 71, which is what? Their cash and bank. Let's come to their cash flow. 210 and then what? 71. Let's look at that. This is GOIL. So can you see here the 210 and then a 71? But they had a bank overdraft and other financial assets. So we put together everything and get your cash and cash equivalent. So although they are explaining the movement from 210 to 71, in the true cash flow, it's cash and cash equivalent. So here they put everything together and got what? 126,373, this figure, and then 265,877, this figure. So instead of just explaining cash, this is a company that has a short-term overdraft, which is also a near cash item. They have to pay within 12 months. So they typically would net off all of those. But the point is, we still try and explain the movement between this and this. Are we good? Then, like I told you, it will have what? Operating activities, investing activities, financing, every cash, OIF, right? O, I, and then F. So let's try and look at a few examples here. So it means for GOIL, acquisition of PPE, 274 in brackets. I said bracket means outflow. So they spent 274 million buying assets during the year. Right. Then they also received interest and dividend from somebody they've invested in. Because it's money coming in, there's no bracket, 6.2. Let's look at their financing activities. So they paid dividend of 21.9 during the year to shareholders. And then for that loan, they probably paid off some 73, right, during the year. So this is basically a cash flow statement. Broken down into OIF, explains the movement in cash. We can look at Nestle. This is Nestle's global financials, right? So you can see first thing is they don't report in dollars. First thing, right? So at least, like I said, look at the currency at the top. Look at the currency at the top, right? CHF is basically the Swiss franc, by the way, in case you don't know, this is the Swiss franc. That's why I said always check at the top. They'll tell you what currency is it. We've seen Nestle. Nestle is saying CHF. GOIL is saying Ghana cedi in thousands of cedis, right? So Nestle is saying, okay, this is in millions of CHF. So look at Nestle. You pick their financial sales. They said check notes 3. As usual, we have 23 and 22, and it's for the year ended December 23. So they show you this year and last year. When you zoom in, they are saying, go to note 3 for the sales. They brought their other revenue. You can see they have a slightly different presentation. Other revenue, cost of goods, so distribution expense, marketing, blah, 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 trading operating profit. Sometimes based on industry and jurisdiction, there might be a slightly different presentation. But the point remains the same. This income statement shows you Nestle's revenue and income and their expenses and any profit or loss. So Nestle made a profit for 2 consecutive years. Profit for the year. But I want to show you something. Let's take some notes. Let's go to Nestle's note 3 and see something there. Nestle's note 3 tells you, see, 92998 is how much they sold. Let's confirm it. 92998. So Nestle is telling you that out of the 92998, they made 24.7 from powdered and liquid beverages. Water, their water products, water bottles and all, gave them 3.3. Milk products and ice cream gave them 10.9. Nutrition and health science gave them 15.2. Prepared dishes and cooking aids, your Maggi, what you use in the spices in the kitchen, gave them 11.6. Confectionery, the sweets and all of that, gave them 8.1. Pet care gave them a lot of money, actually. So products for your pets, right? So they've told you that, oh, if you want to know how much money we made, this is the breakdown, right? Sometimes they may give you what we call segment information. So they've broken down into North America, Europe, Latin America. You see, they've also given you that same 92,998 into different business zones. This is not mandatory. It depends on the company and what they want to disclose. Once again, because it's a language we are speaking, there's something called IFRS 8 for the accountant here, operating segment. It requires certain disclosures to be made, but that is also outside the scope of our discussion. At least you know that they've given you the breakdown of the 92.9 according to products they sold and the locations where that money came from. This is Nestle. Then we can look at Nestle's balance sheet and extra. You can see Nestle is also showing you that they have current assets and non-current. Have you noticed Nestle brought their current before non-current? Who has noticed? Let's look at Goyle. Goyle gave you their non-current first before their current. Once again, you might notice that difference in some word company's balance sheet. But what you can go home today with is that you would definitely see your assets, your liabilities, and your equity on the balance sheet. So let's look at Nestle's balance sheet. So they have cash of how much? 4.8. This is in millions. So that is in billions. That's a lot of money. 4.8 billion Swiss francs in their bank account. But they also have investment. They have, you see, their inventory is one of their largest lines. Why? Because they sell, we expect it. Nestle must have a lot of inventory. But they also have a high number of trade and other receivables. People have bought and have not paid. Then under the non-current assets, we have PPE, which is 30, a big one. So this would be their factories, their offices, their warehouses, all of those. Their intangible assets are here. You typically see goodwill if they have purchased another company for more than the company is worth. So if you see goodwill of, let's say, 100, it means you paid 500 for a company worth 400 to give you the 100. Once again, beginner definition. There's something called fair value of NCI, but let me not stress anybody. So goodwill is just how much you paid for extra over a certain. So it means Nestle has some investment. They paid 28.6 more for that investment than it was worth at a beginner's level. Then this is the, I don't think I showed the equity. Yes, I didn't. So this is just the extract of their asset side, current, non-current. Search online, it's on their website. You see they have non-current liabilities and current liabilities and equity. Finally, we'll end with EcoBank. I wanted to show you a bank. You are not going to see revenue and cost of sales because banks don't sell anything. Banks take your money, loan it out, and make some money on it. So you start with interest income. This is how much money EcoBank made from what? Giving out your money to others as loans and charging them interest income. Once again, they are telling you, go to note 6 if you want the details. This is in thousands of Ghana cedis. They give you 23 and 22. What I've taught you stay with you for life. You see it every year, every financial statement, in every set of annual reports. Interest expense is what Nestle pays you and I for keeping our money with them. You see how much money they are making? They are paying you just 699, but they're making 4.2. What? A lot of money. This is billions versus in thousands, right? 4.2 billion cedis just from giving loans to other people. And they're paying you 699 million. You see the margin. So their net interest income is 3.5. They made free money from you. They paid you 699 million to keep your money with them, but they were able to be smart enough to loan it to others for higher interest. This is how banks make money. That is why they need your deposits. So if you see someone coming to you to beg you to create an account with them, it's because they want to do this magic with your money. They want to give to somebody at higher. That's why they can be on your neck. Please come and open an account with us. They want to do this magic with your money. That's their business model. But it doesn't end there. They also have fee and commission income. They may be paid commission from other banks for doing a certain service for them. They may also receive fees from you, credit card fees, bank statement fee, ATM withdrawal fee, you name it. They are making 600 million from just that. So the 30 cedis they deduct from you every month, it is your own, my own, the third person's own. They add it together, and this is how much money they are making. You can see a bank doesn't have revenue cost of sales because this is how they make their money. But they also have fee and commission expense. They will incur some fees to other people and pay some commission. Then you get your net fee and commission income, which is this minus this. Then they have their net trading income and other operating income. You see gain on sale of equipment, like I mentioned. EcoBank sold some equipment and made 500,000 cedis, 592. That equipment income cannot come to interest income because that is not what it is. EcoBank is there to actually give loans from your deposit. So if they sell an asset and make money, it can only be what? Coming in as other income. Then you get your net operating income. Then banks have their own issues I will not bore you with, like what? Impairment charges. These are loans that have gone bad. So you can see we have a lot of money sitting here. Loans that will not be paid that they've written off. Modification loss is also there. Personnel expenses. They pay their employees over 600 million cedis as salaries during the year. So we can say EcoBank paid more than their total fee and commission income out as salaries. As a shareholder, would you be worried? Maybe. You paid more than your total fee and commission income out to employees as salaries, right? But yeah. Then depreciation and amortization. I'll touch on this because it didn't come up. Depreciation is on the usage of tangible non-current assets. Amortization is for intangible assets. The more you use assets, the more they lose value. That loss of value over time is called depreciation for the tangible assets, the ones you can see and touch, called amortization for intangibles. Then they pay their taxes. This is their income after tax for the year. They made a profit. Then EcoBank's notes, right? So you can see we said note 6 is interest income. Note 7 is interest expense. When you go to the note, this is what you see. Note 6, interest income. So this is how they made their money from placements and short-term funds. This government securities, non-trading. This government securities trading. This and then loans. This is the biggest one. So more than half of their interest income came from loans, like I told you. That is how they make their money. Then interest expense, the one they paid you and I. Demand deposit, time deposit, borrowed funds, savings account. You see savings account. That's why you shouldn't have invest it in T-bills or get a fixed deposit that has what high interest rate. But yeah, that's just by the way. Then they break everything down, right, into these component parts. So you also see the other ones here. No need to go through. It's online, so you can just Google EcoBank's financial statement. So that is about it. These are still the notes. Personal expenses, they paid salaries of 322. Others are here. We don't know what the others are, right? And it's a lot. They didn't give us a breakdown too. Then social security contributions are here. Defined benefits for retirement sake, right? Okay, so that is it. That is it. We have their operating expenses here. They spent 18.6 million to do adverts during the year. That's a lot of money. But yes, all the adverts you see wherever, they spent a lot of money on that. They took their employees for training, 2 million. A business that spends more on adverts than training, no comment. Auditors took a big chunk of the money as well. Directors also took plenty money here. And then they did CSR, 3379. They said check note 45. They want you to know the good they did during the year. So, ladies and gentlemen, that is it for today. This is their balance sheet. You can see they don't have current and non-current. That is for banks. They list the assets merged together, many banks. So you just see assets, you see liabilities, and you see equity and reserves. But the point remains the same, that every balance sheet will show you assets, liabilities, and equity, right? My job for today is done. I'll take any questions you may have. Because of time, please raise your hand first if you have a question. I'll call you and then you would come in. This session is worth how much in US dollars, but you got it for free, right? So to clarify, it could have been a whole session you're going to pay so much for, but just so you have an idea what's happening, right? Let's go with Raymond. Raymond will go first, and any other person can come. You're on mute, and then you can speak.
Okay, so thank you very much. I just want to get some clarification on the income statement. When you were talking about the operating expense and then other income, I think you mentioned that when there is FS gain or loss, should be treated, if it is gain, it should be treated in other income, and then loss should be treated in other operating expenses. What I want to understand is, in case you are operating, so FS gain should maybe, let's say USD and then Ghana cedis, and your financial statement is being prepared in the, let's say Ghana cedis. How do you treat that one?
Are you an accountant? So your question is not for this forum. I don't know if you understand. We have people here.
Okay, that's fine. That's
definitely gain or loss you do in IES 21.
Yeah.
That you, yes. So it's not for this. Let's not have idea, right? So let's be fair to them, right? Lodina.
Yeah, hello. Thank you. Yeah, thank you for the presentation. Please, I wanted to find out what the comments you made on the let's say with EcoBank's bank balance sheet, the one that has the company invested more in advertising than for staff training.
Yeah.
Would you say that maybe if they train the employees, because employees may leave, they decide to invest more in adverts than looking at, is there a way to secure, if assuming it decides to train the employees, invest more in training employees, is there a way to secure their investment other than the advertising?
As for this, is a business strategy issue. Every business needs advertisements to get seen. So as popular as EcoBank is, they need to still spend money to get people to see them because the competition is very tough, right? So that comment I made was just like a passing comment, like, oh, they pay so much to advert, and it's necessary, right? Training is important, but a bank of its stature in this competitive climate, it is expected that they invest in adverts. So I think it's just fair that they spend that much to do adverts, right? Some even spend more than that. Some spend less, but it will vary year on year, right? Okay. We have Davido. That's your name showing here. Okay, no, Collins next then.
Collins, hello, Mike, can you hear me?
Yeah, now I can.
Okay, thank you. When it comes to the balance sheet, you have for the long-term loan and the short-term loan. When accountant, when they do that, do they include the interest portion or only the principal?
So whatever is on the balance sheet is what you have payable, and what you have payable is both interest and principal.
Oh,
so
okay.
There should be what you are owing the bank. If you show your shareholders just the capital component or the principal, you're not being fair to them. Let them know what is owing at the end of the year. So show them everything.
Yeah. But the interest will come on the P&L, right?
Yes, only interest. You don't show the principal on P&L, just the interest component. Yeah.
Oh, okay. Okay. Yeah. All right. Thank you.
All right. Then Collins. If Collins, okay, yeah, go ahead.
Thank you for the presentation, boss. Please, I want to ask, how will irrecoverable debt be treated in the financial statement?
How will irrecoverable debt be treated? It's written off. But then again, it's not a question for this platform, right? So you, because of people here, but irrecoverable debts are debts that cannot be recovered. So they are written up as an expense. So double entry, you clear the receivables from the balance sheet and the expense hits the income statement, right? But I want basic questions on what we just did, right? But that's the answer, anyways. That's the answer. Then eMark text solution. Please make sure your questions are related to like basic issues, not accounting advisory. Okay, we can have another session for that. eMark text solutions. Your hand is up, but your mic is not on. If not, any other questions from anyone? Any other questions? eMark, you can go ahead. Unmute and then speak.
Okay, so good afternoon.
Yeah.
Okay, so my question is just simple. I've been I'm doing a bit of accounting for a traveling agency where
You've been doing what?
you know, accounting, like a setup,
Okay.
something of that sort. Like I'm the one doing the setup for them with the system
Okay.
actually. Yeah. So what they do is that they are traveling agencies. Okay, so when it comes
Okay.
to ticketing and visa requisition and
Okay.
that stuff, they have partners where they get those services from them. So what they actually do is that they calculate the percentage on the amount charged to the customer, which is, I mean, billable expenses, right? So now,
Okay.
in getting the P&L reports, okay, so they are only interested in what the commission, the percentage that they charge on the what, the amount to the client. So they only want that portion to be their income, where the billable. So let's say the visa fee is 200 cedis, okay, and they're supposed to charge 10% on that 200. So at the end of the day, the total amount that they'll be billing the client is 220. Okay. So the 20 series component, which is their profit, they want that to be on their income level, at their income in their income statement as only income. They don't want the what the 200, which is what I think the partners or they are supposed to pay to the partners or the sponsors of what the visa. So I just want to ask a clarification. Is there any possible way where if that's the right way of what going around it?
So let me ask you a question.
Yeah.
Let's say 200 Ghana cedis is the visa fee.
Yeah.
And then extra 20 is on that for you, the company. Is the 200 yours? No, it goes to the embassy. So why do you want to do it as your revenue? So they will not be wrong for just showing the 20 on top of that, because your true revenue is the 20. But what you can do is you can show the 220, show a cost of 200, leaving 20. Some will just show the 20 directly as revenue. Either way is fine. But remember, your true money is the 20, not the, because this 200 goes to the visa or the embassy, not you, the company. So it can't be your revenue. Yeah.
Exactly. So that's what we have been fighting for, but they are not ready. They are saying that all the 220 is supposed to be what in their income was in the statement. Which are saying that the 200 is not yours. So I just want to, they say, so now there was a name, the 200 which is what, a payable or a bill to what, the embassy. So they want that to be what, I want to treat it as a payable to them, but they are not what, in accordance with that. So I think it solved this, right?
Okay, so I have told you what it should be. If they don't agree, just get a consultant to speak to them. Or if you have an audit, you should have an auditor for sure. Let your auditor
I have an auditor. Yeah.
Great. Let your auditor just speak to them. They will give you like a final position, and I think that should solve it. Right.
Sure. That's fine.
Okay. David again.
Yeah. Okay, Mike. Thank you. The goodwill that you talk about. I know in accounting, you have all the debit and the credit, correct, in every transaction. So right now we know that the goodwill will only be one part. So how you treat the other part?
Goodwill is not one part. That's why I said it's outside the scope of this discussion. So the accountants here, there's something called consolidated financial statement, consolidated. So you prepare a whole suite of financials. I don't want to confuse you if you're not an accountant, right? Are you a CA? If not,
No.
okay, then you end up confusing yourself. But let me try confusing you since you want to be confused. So when you are preparing your group account, there are certain elements. You see goodwill, you see non-controlling interest, right? And you see retained earnings. There's a whole process we go through to prepare those group accounts. So let me try and see if for the ones we had here. Okay, incoming. Which one had goodwill? Meanwhile, if someone has a question, they can ask. Okay, I didn't show Nestle's extract, but let me see if I can show it on this other screen. If someone has a question next, they can ask whilst I look for this. Why is Nestle's financial statements? Anyone with questions can go ahead. If you have question. Okay. I had Nestle open somewhere. I'd have shown you their, let me open it again. I think this is it. Nestle financial statement. Okay. So we expect to see something called non-controlling interest, right? Since you want to see, let me show you. But for the rest of us, you can close your eyes. It's not part of the discussion. Okay. So share entire screen, this. So as you can see here, this is cash flow. So this is their balance sheet. So this is what I showed you, right? There's goodwill here. When you come here under their equity, you can see non-controlling interest. These are the minority interests. So there's a whole set of things that go on behind the scenes. So when you say there's no double entry, it's incorrect. There's a lot of things that will happen before the goodwill will appear here and the NCI will appear here, right? But that is obviously outside the scope of this discussion. It's like at a really advanced accounting level. So maybe that'll be it. But that also show you that it's not just goodwill. There are other things that must be shown, right? Okay. Any other? Yes, nah.
Apologies, I raised my hand in error.
Yeah. Say that again. Or goes an error. Okay, that's fine. Any other question?
Okay, Mike. Please, the other comprehensive income. Okay, the taxman will be will it be like of use to the taxman, or you just focus on the operating income of the company?
Mostly just operating income.
Okay.
Most operating income, yeah. Christabel.
Please, I want to know the difference between the cost of sales and then the operating expense.
Okay, cost of sales are your direct cost of doing business. So the example I gave, if you joined early enough on the lady selling the wigs, the cost of the wigs that she bought to come and sell is her cost of sales. Her operating expenses will be things like data cost, delivery fees, electricity bills, salary for her employees. Does it make sense? So cost of sales are for your direct, like you deal in wigs, you bought wigs for so much. That's your cost of sales. Then operating expense will be your other expenses, utilities, internet, stationery, staff cost, employee expenses. Right, that's the difference. Right, yeah, Adam.
Yeah, sure. Thank you.
Okay, Adam.
Hello, sir. Please, I wanted to find out about the deferred tax. Is it yes, please.
Outside the scope of this discussion. Right. Unless you are an accountant, then we can talk. If not, don't bother. Are you an accountant?
Yes, please.
Okay, so what about deferred tax?
So I wanted to know how it's beneficial to the tax person.
It's an accounting estimate. That's it. There's no thing as yes. So there are rules around deferred tax in IAS 12. If we were doing an ICA program, I would happily teach you deferred tax like I do to my students, but not this platform, right? So you deferred tax, it's an accounting estimate on taxes. It doesn't mean it's tax you're going to pay, right? It measures the future effects of taxes on your current transactions at a very basic level, but really outside the scope of this discussion, right? For a beginner, yeah. We can take 2 more questions if there are. If not, we can sign off at this point. Any further question? Any further question? If not, then we are done for today. I want to believe it's been 2 hours well spent because time is expensive. So at least you should leave here knowing that you have gained something, right? So we will share, this recording will be on the MSL Business School YouTube channel. We'll share it again via email to your same email address. So you want to go through it later on, you're at liberty to, right? So that is it. I'll wish you the very best in the day ahead. Have a lovely day. And I look forward to seeing you at our next webinar. Enjoy your day. Bye.